Hi, everyone. Thank you for tuning into our NBI podcast. Today's topic will be on the state of the economy and the potential impact on fixed income strategies. And to help me navigate the subject, I'm joined by François Galarneau of AlphaFixe Capital, senior economist and partner over there. Welcome, François. All right. So, François, let's start with the state of the economy. We know that last quarter of 2025 was a little softer than expected due to the shutdown in the U.S., but overall, 2025 was pretty strong despite the tariffs and the uncertainty on the economy. So what's your view or your take on what's to come in 2026?
Well, before we go into 2026, we're just going to have to take a step back and look at 2025, which was quite a resilient economy right now. The way we look at it is that the economy managed to grow at around 2 or maybe 2.5% or 2.2%, maybe 2.5%.
Around potential.
Yeah, close to actually above potential, which is 1.8 if we're taking a look at the Fed forecast. But it was actually pretty good growth compared because we had some good shocks in 2025. First, we had the Dodge with Elon Musk getting rid of close to like 600,000 people, and then we had the tariffs in April the 2nd. We had the immigration policy, and also in 2025, and the shutdown. So we had some pretty good shock in 2025, and managed to get some good growth and good growth coming from the final domestic demand, which is, if you take away all the noise from the tariffs and all the international trade and all the inventories variation between in the companies, and you take a look only at consumption, investments, and government spending, it's pretty solid in 2025 and maybe the last quarter was a little bit mild because of the government shutdown, and people just some of the people that were employed by the government didn't get their checks, and we know there's a lot of families in the household over there that live from paycheck to paycheck.
Yep.
So consumption in second quarter and the last quarter was milder than the previous ones, but we still managed to get some really good growth, which gives us that the economy is stronger than people have thought. The only thing that bothers us right now is that if you're taking a look at the consumption in the States, it's holding up pretty well, but revenues from wages are not holding up to the same rate. Consumption is around 5% on a nominal basis, and revenues are around maybe 1 or 2% right now. So people are just drying up their savings to spend a lot. And if you take a look at the savings rate as a percentage of disposable income right now, it's at 3.6%. Taking away all the noise from the pandemic area, we have to go back into 2020, maybe 2007 or 2008 to get a savings rate as low as 3.6%. So in this area right now, in 2007, 2008, people were just using their cash from the houses and the gain they get from housing prices, and they were just they were borrowing against that to spend. Right now, what we're seeing is that there's also a wealth effect coming from the stock market. From, like you said, there's a K-shaped economy, a wealth effect coming from the upper end of the income distribution that are spending from
people that have money have money.
Exactly.
Yeah, they keep spending.
They keep spending from the gains they get from the stock market, but people from the bottom K are just drying up some of their savings to keep on spending.
The cost of living is really having an impact on them.
Yeah, especially food right now.
Yeah.
Food is really is a big subject in the state as far as the cost of saving, cost of living.
Something that monetary policy doesn't have much traction on, right?
At all.
So what's your forecast for 2026? Are we going to see some similar growth, or what are you expecting?
Well, actually, we're at a stage at this point right now that is actually not dangerous, but we have to monitor what's happening, because if you take a look at just at the labor market, take a look at their labor market at this point right now. It's pretty stable. It doesn't. There's no hiring, no firing. There's actually no growth in the labor market. In the last year, if you take a look at the BLS number, there's only 181,000 people that got hired in 2025. Most of them were just in health industry. If you take away all the healthcare industry, I think you're losing around 400,000 people, 400,000 jobs in 2025. So right now there is just no growth in employment. What scares us is that every time there's a recession, there's always growth in employment, and there's like a stabilization at one point, and then everything shuts down, and there's a recession.
Yeah,
we're at this point right now. So in order for the economy to keep on growing, we need to get some more jobs. Household cannot continue to spend using their savings as have seen in the last couple of quarters.
Okay.
Especially with the stock market, if it's not going up, then we're going to lose all the wealth effect from the stock market as well. So we need to see some jobs in the next couple of months. If we don't see jobs, and if it keeps on being what it is right now, even start to drop, then we can go into a recession pretty easily.
So you're expecting a deceleration that could lead to a recession
actually,
at some point in time?
At this point,
2026?
We're looking at the job market as an indicator, but we are not thinking that 2026 will be a year that we are falling into a recession. Because
how much of that could be compensated by the AI frenzy and the impact on capital spending? And is it possible to see no hiring, no firing, no job growth, but still the economy being staying robust?
Well, we're going to see a lot of investments coming from the companies because of the Big Beautiful Bill. People can just invest right now, and there's a acceleration period of amortization, so you can just amortize all your expenses in the first year. So that's pretty interesting as far as a company to do it right now. So there's going to be some investments in building up the infrastructure. You need to get some workers and everything. So there's still going to be some activities that's going to create some jobs eventually. So the Big Beautiful Bill, as far as we're concerned right now, is that there's going to be a big refund coming in April, because all the taxation, the lower bracket that we have in the one Big Beautiful Bill applies to the 2025 tax refund. So in April, some people will get a big refund, bigger than what we had in the last couple of years. And also in 2026, we do have a new taxation bracket that is lower. So there's going to be more people being able to consume. So a shock that's coming over in April from not a wealth effect, but just more money to spend. And also more companies are going to be investing and spending even if it's just to create or get big data centers, you need to build it up.
Yep.
And you need to employ people to build it up. So going to be activities in construction. We've seen
energy generation.
Energy generation. Actually, what we've seen in the last 4 quarters, around 70% of the annual growth in investment from companies goes into AI.
Yeah.
And the part that goes into energy generation is pretty small right now. So it's going to be some kind of a bottleneck somewhere.
Yeah.
Because you cannot build such a big infrastructure in AI without having all the energy to supply it. You need to have the energy to supply everything right now. And I think there's, at one point, there's going to be a deficit in energy to supply all the information, all the AI that we have. So there need to be investment in there. We have to see in 2026 if we get some. But 2026,
how fast they can do it.
How fast they can do it, because
What about, we haven't talked about tariffs very much, but the Supreme Court of the United States has just invalidated Trump's tariff for 2025. So what's your take on that? And we learned this morning that it was 10% instead of the 15.
Just kidding.
Yeah.
It was supposed to be 15% Saturday, Trump told us. But all the numbers that they got from the customs right now is that we have to charge only 10%, not 15%.
Yeah.
We're going to take a look tonight if Trump changes it to 15%.
And the law says for 150 days, if I remember correctly.
Exactly. Above that, you need to get the approval of Congress. Yeah. And he doesn't want to go there because the Congress doesn't approve all the tariffs right now.
Okay, but is that a positive? I mean, is that 10%? It's lower than the effective rate that was in place.
It's lower than what we had before. Yeah. As far as the effective rate, I think the budget lab came in at around maybe 9% right now. It used to be 16, now it's around to be 9% if we have the 10%. But it needs to get revenues from tariffs in order to get
finance,
in order to get the budget balance, not budget balance, but to reduce the deficit as much as possible.
Yeah.
And the one big beautiful bill, there was a lot of less revenues coming from taxation, but eventually you get revenues from the tariffs in order to compensate that. If you're losing that, you need to get revenue somewhere else. So. That's why he wants to have this.
Or you need to cut spending.
Need to cut spending, but that won't happen.
Yeah.
That won't happen.
Not before the midterms, right?
Exactly, not before the midterms. But as far as the strategy is concerned, we had some kind of a period that we had nothing related to tariffs. It was just calm, easy going.
Yep.
And now we're going into another area of what is going to happen with tariffs. Is he going to go 15%? He's looking at different section of the tariff act that he can apply in different areas, different sectors. So there's going to be more uncertainty going forward with tariffs in 2026. But because it's a midterm year, I don't think he wants to go into a big fight in tariffs right now and get the stock market going down big time, because the stock market is on kind of a pull for him on the economy. If the stock market goes well, he thinks that his policies, the economic policies, are good, and you should continue.
So you should look at the rest of the world, because the U.S. stock market is on a relative basis is not doing as well as the rest of the world. Let me, you're a fixed income guy, so let's turn the subject onto monetary policy.
Yes.
How do you see things evolving? We potentially have a new
potentially
Fed
he needs to get confirmed by Congress.
Yeah.
And right now, I think there's one or two senators from the Republican side that are
reluctant to approve
exactly. As far as the accusation on Powell are still in place, then they won't validate the new president right now.
Okay. But let's suppose
that he gets it. Yeah. I know that he's a guy that was looking at AI as a deflationary environment. So he wants to cut rates for sure. The problem that we have right now is that he had a stance because he was on the Fed before. He had a strong stance against QE, and the part of he wants to get rid of, not actually reduce the balance sheet of the Fed, because he doesn't believe in QE. So we don't know exactly how this is gonna turn out, because if you are starting to reduce the balance sheet at a time when you need more and more.
There's going to be a lot of supply.
There's going to be more and more supply, because you don't get the revenues from the tariffs to compensate for the one big beautiful bill reducing tax that you get. So there's going to be more deficit and more supply of bonds. And if you're selling bonds as well, you need to have the investors to get it. So it's going to be some risk. There's going to be some risk in the long end of the curve. Just because of that, if you're taking a look at the world right now, there's more opportunities elsewhere. In Japan, for example, a lot of investors from Japan were buying treasuries. Now they can get 30-year bond in Japan at 3.5% roughly.
Yeah, okay.
They didn't get that before. So they're going to be more reluctant and investing in the States because they can get their own, they can finance their own government at pretty interesting without any currency risk. Same in Europe. There's some alternatives in which investors can invest right now at the same kind of yield that treasuries offer. So the pool of investors that are going to be buying treasuries is shrinking a bit, but it's going to be more and more supply eventually down the road if he gets the balance sheet reduced, and that, for the long end of the curve,
should exert upward pressure, I guess.
Exactly.
Yeah, okay.
Upward pressure on the long end of the curve.
So you see on the economy side of thing, maybe a slowdown, a deceleration linked to.
Well, actually, the economy can surprise. We're looking at the employment market right now, and if the job market picks up in the next couple of months, then we can get spending keep on going. And if you take a look at the inflation at this point right now, even the core PCE was pretty solid, around 3%. Inflation can surprise on the upside, even though the Fed wants to reduce the rates by maybe like 2 times or 3 times in 2026. Because
so where would inflation come from? You say, hey, high is deflationary.
Actually,
we got the housing pressure.
From if the job market picks up, and you still have all the immigration tools, all the immigration policies that are constraining the supply of labor, then you're going to have a problem getting some new workers, and you're going to have to pay up to get the new workers.
Okay.
So demand can surprise, and the economy can surprise as well in 2026. Eventually, if we get a check from the tariffs going into households. I know that a lot of companies are looking into getting back their money from the tariffs they paid. There's going to be a litigation in the next couple of months on that for sure. But I think the stance for the White House will be, you guys didn't have the burden of paying up the tariffs. You pass it on to the consumers, so you're not going to get the money. We're going to give it to the consumers.
Yeah. And that too would be inflationary.
And that too will be another
more
shock.
money chasing too few goods.
Exactly.
Yeah. All right. So, what in terms of strategy? What sector of the fixed income world do you favor, or in terms of duration, or maybe corporate bonds? What's your take on that?
Not corporate bonds.
Not corporate bonds.
Not corporate bonds. Actually, if we
spreads are compressed
exactly,
too.
Spreads are pretty tight at this point right now, and you have to go back into 2007 or 2008 to get a spread as tight as we have at this point. But the quality of the index is not the same. In 2008, the percentage of triple B in the index was much lower than what we have at this point right now. So you have the same yield, same spread, gives you, but not the same quality of bond.
Okay.
Not the same quality of companies.
So you're saying it's too risky right now.
It's risky at this point.
The
you
spread
don't get
is not wide enough to compensate.
If you widen a bit, then you're losing all your carry.
Yeah.
Eventually.
Right.
And what we're seeing at this point, and it's something that bothers us right now, is that we're seeing a couple of companies from the States that are coming into Canada and get financing, even though they don't have any activities in Canada. They're from the States. They don't have any assets in Canada, no activities in Canada, but they can get financing in Canada using a one credit rating, because in our index it's only one credit rating that it's that you can get to get into the index. You just need one credit rating. There's actually a Bloomberg article saying that DBRS has been really loose on giving some triple B minus, which is just a notch above a high yield. So you're still in an investment grade, but you can get a credit rating in triple B minus from DBRS. And still get into the index and get financing from investors in Canada. And there's been a lot of companies recently that wouldn't be able to get financing on an investment grade basis that just got one rating from DBRS and managed to get into the index. If they got a rating from S&P or Moody's, it would have been a junk rating or high yield rating, and they wouldn't be able to finance at the same kind of level. So that's a stretch in the market at this point. That it's worrying us, because usually when you see those kind of stretch, you're at the pretty much the bottom of the yield, the spread that you can get. Eventually, everything will pick up. So if there is a recession coming over from the States because the economy doesn't, the job market doesn't pick up, and we're going into a recession eventually, then for sure spreads are going to widen in 2026.
And that's when it's usually a good time to go back in.
Just be careful. Just take a look at the market. We've seen the last couple of weeks, we've seen spreads widening a bit, especially in the corporate, even on the Provi side. So spreads widening a bit. So just wait, go into a defense mode, maybe close to the index as far as weight is concerned on your credit. Wait until spreads are gapping up, and then get into the market at this point. But right now, I wouldn't touch it. I would just keep a low profile in the credit market. Duration also, it's just the long end of the curve scares us a bit. The short end will be eventually, because we have not in Canada. Canada will not change the rate whatsoever in 2026, but we're going to have some rate cut in 2026 from the Fed, maybe 2 or 3 rate cuts.
But that's already priced in,
But
right?
it's already priced in, so it's not going to be a lot of changes from that. But the long end, if the economy picks up and it's inflation is higher than what market was expecting, and even if the inflation is higher than market is expecting and the Fed stop cutting rates, the long end could actually also get priced up as well. So be careful on the duration. Just watch the job market at this point. If the job market picks up, then the long end of the curve could be really dangerous. If the job market slows down, and even we're losing jobs in the States, then we're going to a recession. But at 2026,
it's always a balancing act, right? If borrowing costs do go up, then
but
recession scenarios come back in the markets, and the
job market is just doing nothing.
It's
just doing nothing. So we're at an inflection point in the job market. Either it picks up again, which it has never happened before, which that's the reason why we are.
But we could
concerned.
be in sort of a jobless recovery, like what we got in the 90s, where the economy's doing well, but
and what the companies are doing right now is that with all the uncertainties we had, is they managed to answer all the demand without adding more jobs, and just using what they have at this point, using the employees they have at this point, and getting all the profit at this. The economy is growing rapidly, but the job market is doing nothing. So what's happening is that the companies are getting more and more profits from that, and the profit of the companies as a percentage of the GDP is at a higher level right now. So the companies are just they're gonna wait. They have the time to wait, because it doesn't affect their margin at this point. And I think they still have PTSD from the pandemic area, in which they had problem getting some new workers. Remember at one
skilled
point
laborers.
There were 2 job offers for one unemployed person. Now it's balanced at 1-for-1, maybe a little bit lower. But it took for companies maybe a couple of months to get a new worker that they were looking for. So before they're laying off new workers, or before they can get some layoffs, they will think about that and make sure that the demand is really slowing, which we are not seeing at this point. Demand is still there for investment and from consumption.
And of course, there's always the hope of productivity gains coming from AI. Thank you very much for participating. François, it was a pleasure of having you. And for all of you watching, we'll talk again next month.
Thank you for having me.